All right, I've been talking about this, but do you know that Google now is stumbling toward its second bear market this year? Now, the company's investments obviously are putting folks off, but it's been brought up throughout this show that this is a lot of money that they're spending or investing, right? And that is fueling generational wealth for a lot of little niches in this market, a lot of smaller names. We've been bringing to you for the last few years, been killing it. Now, my next guest is one of these guys, right? And he points out that even though it's the most profitable company in the world, and so some may say, well, why is it in free fall? Let's bring him in. Shay Boloor, Futurum Group, their chief market strategist. So I spent a lot of time in this show on Google. If you have something you want to add, fine. But Shay, I want to get to the opportunities. Are you a buyer of Google and weakness here?
Yeah, I think it's really difficult to ignore the video game like numbers that Google's reporting. I mean, we're talking about 82% top line growth, 36% operating margins. And this is happening at a time where they're continuing to raise CapEx. And people who are arguing, like, where's this money going to? Why are they raising $15 billion every 3 months for CapEx? Well, did you just see what their cloud business just produced? Like, this is a company that's truly evolving from primarily being dependent on advertising in type of business to one that has 2 major profit engines. And the AI strategy is clearly working. And I do think the debate is just near-term financial heartburn, but that's fine because it's scaling into something that's going to be drastically bigger and a clear winner of the new AI economy.
Yeah, well, listen, going back to Amazon, I think when Jeff Bezos rewrote the rules, Wall Street used to beat up that stock like crazy. When are you going to be profitable? He was like, I'm building something that's going to be magnificent. In the end, people who bought Amazon on weakness have made a fortune. I want to ask you about Intel. They report after the bell. Stock's been a little bit shaky. One day it's down $5, the next day it's up $5. What's going on?
I think there's like a clear dislocation that's happening right now in the AI trade. I think you're seeing names like NVIDIA trading under market value. You're seeing Google getting sold off at 25 times earnings when they're clear AI winners. You're seeing Micron also being valued at 6 times earnings. But you're seeing Intel being traded at over 100 times earnings. So that's clearly telling the market's clearly saying that this build out is going to last to the end of the decade. So that's why Intel is catching a bid when the other names like the NVIDIAs, Google's, Microns, they're being priced like there is peak CapEx spending right now that it's not really providing an ROI. So I think that Intel is going to have a very high bar to produce in earnings this afternoon. I don't think it's going to produce what the market wants, which might create an opportunity to get in at 10, 15% lower.
So let's talk about Micron for a moment and this notion that, hey, the spending will stop at some point. When do you think the stock should reflect that? The market is smart, right? So the market will peak before the spending peaks. Is there a time frame in your mind, 6 months, a year, 2 years? Because some of these companies have 2 or 3 year visibility.
It's going to be a minimum of 2028. I think we have 2 years of continuous pricing power on the memory suppliers. I don't know if it's going to be 85% gross margins, but we're clearly seeing, like, even Google, their latest Ironwood TPU, that includes 190 gigabytes of HBM3 per chip. So that's showing how much amount of premium memory is going to be required across every one of these clusters. And that combined with the billions of tokens every minute that Google's APIs are producing to serve these Gemini models, like, that's creating a huge opportunity for HBM suppliers. And Micron has probably the least amount of HBM market share, but that rate of change in that part of their business will be exponential, and that will cause a re-rating of the stock because it starts from a smaller base, and the more and more it gets as AI evolves, the better their fundamentals become.
You know, CoreWeave put out a great chart this morning, the next NVIDIA rack, and just the demand that it's going to create. Of course, right after the earnings last night with Google, and Nebius went through the roof. This is a name that you've liked. It's come on like gangbusters here recently. How much more upside do you think?
Nebius probably is the highest torque infrastructure read-through of what Google just communicated yesterday, because that third-party capacity as that temporary bridge of what Google is communicating yesterday on the conference call, that is exactly what Nebius is building right now. It provides immediate, available, full-stack AI infrastructure to customers that can't wait for these hyperscalers to construct more data centers. So I think the runway is massive. I think they're perfectly positioned in the agentic AI environments. Management has already said that 4 or 5 customers are competing for every GPU that brings online. That tells you the imbalance right now on the supply and demand. And Nebius is perfectly positioned to capitalize on those Microsoft and Meta agreements they currently have right now.
Well, I tell you what, people have been buying these names on weakness, the dips, and it's been working big time. So folks, fear not. All right, Shay, thanks a lot, buddy. Great talking to you. All right.